China's surprise interest rate cut yesterday may have given a lift to stocks here, not in China itself, though. With the market slumped, the Shanghai Composite capping its biggest weekly slide this year on growing concern that the economy in China is slowing even faster. Fred Neumann is co-head of Asian economics at HSBC. He is with us from Hong Kong this morning. Fred, the consensus seems to be that one rate cut won't be enough for China. How much more do you think we'll see this year?
Actually, we thought that yesterday was a very big rate cut. In fact, if you look at the details, it's almost 3 rate cuts wrapped into one. So we don't think there's going to be one more rate cut. But what we need to see is much more fiscal spending and also cuts in the RRR. So we don't think rate cuts, but other policy measures are certainly needed to revive economic growth there.
How does a 1 to 2% change in growth really affect worldwide? I mean, we know how fragile Europe's state is. What could be the fallout for Europe here?
Well, it's a lot about sentiment. We had Chinese policymakers kind of sitting on their hands for quite a long time, and so there was some uncertainty creeping into the market. Now with China saying we're going to cut rates, we're going to do more, that sends a positive signal, which in itself is important. 1 to 2 percentage point acceleration in China is not going to rescue Europe, is not going to rescue the United States, but at least for this part of the world, which is an important growth engine nonetheless, it does make a difference. And at least regionally, we expect the economies to perk up a little bit over the second half of the year and sentiment to improve.
But can it be viewed as a negative? Because having to say we need to cut, they're sort of showing their hand that things might not be as rosy or as buttoned up as they like to present.
That's right. If Chinese policymakers act aggressively, that always raises the fears that perhaps the numbers are much worse than we had known previously. Certainly over the weekend, we get more economic data that should show even a further deceleration in May from the previous month. But we do think that China's policymakers have the capacity to act. They do have the means to stimulate, and they clearly showed that they are willing to do so now.
Fred, I've seen some commentary, some remarks today that the flexibility that the PBOC gave banks in being able to reduce lending rates on their own is perhaps even more important than the 25 basis point cut in and of itself. Do you agree with that?
Yes, so there are a few things that happened. One is that we didn't just cut 25 basis points yesterday. Banks were also allowed to provide a discount on their lending. So the effective cut is actually closer to 85 basis points. Hence, it's more like 3 rate cuts rolled into one, what we saw yesterday. The other signal is that the Chinese are reforming. It is a move towards interest rate liberalization. Banks are increasingly allowed to set the interest rates the way they feel represents risk, and that is important step towards further financial reform in China.
Is there any concern that an announcement like this could cause Chinese banks to lose deposits because people are fearing, again, as I mentioned, things aren't as rosy as we think they are? And if they lose deposits, and let's say they come here to the U.S. or even to Germany, what could that mean for China?
Well, actually, the opposite happened overnight. That even though the Chinese central bank cut the deposit rate, it did allow banks to offer an additional incentive to retain deposits, and that saw actually Chinese banks today raise their deposit rates rather than lower them, only by a few basis points. But nevertheless, there's a clear signal here that banks are willing to retain deposits and are offering a little bit more money than they had done before. What's also crucial here is that the Chinese authorities roll out a fiscal stimulus, reassuring the population that growth will continue, and that should also keep the money at home.
Fred, the 85 basis points you mentioned, the effective rate cut beyond the 25, the headline number of 25 basis points. How stimulative is that to the Chinese economy? How sensitive are Chinese companies and, more importantly, Chinese consumers to interest rates?
Not terribly sensitive, in fact. The cost of capital in China is very low as it is. Remember, this is an economy that has grown at very rapid pace, and yet interest rates aren't terribly high, all considered. So we don't think that lowering the cost of capital in itself is a big boost. What matters much more here is the signaling effect. The Chinese have not just cut rates, they cut rates by more than was expected, and that suggests that more measures will be following in the coming months, including a fiscal stimulus, including more RRR cuts, and it's that particular part of stimulus that will make the difference.
Fred, it's great to see you, and thank you for joining us. Fred Neumann, co-head of Asian economics at HSBC, with us from Hong Kong, saying that the next move from China needs to be fiscal spending, not necessarily another rate cut.